CFR, welcome into Money Mindset every Wednesday on the show, helping you to see money as a tool, not just a goal, with our friends at Lockshield Partners.
This morning, Clark, I've heard a lot about this SALT, and it's an acronym, but help us understand how this is going to really impact us, because it has to do with taxes, not the sodium where we need to cuff somebody and talk to them about lowering the items that they're eating.
Not table salt.
Not table salt.
The salt deduction. I'm glad you brought this up, Bridget, because we've heard a lot about this in the news, and I think it is misunderstood to a large degree. So the acronym itself, SALT, stands for the state and local tax deduction. So
that's
state
really easy.
and local tax.
Gotcha.
Some really smart lawmaker somewhere came up with the acronym SALT. And let's back up a step before we dive into the SALT deduction for a moment. So we've talked before about the difference between standard deduction and itemized deductions. Mm-hmm. Itemized deductions are the combination of charitable contributions and mortgage interest and the SALT, state and local taxes paid. Previously, the state and local taxes paid were capped at $10,000. So you couldn't report or you couldn't claim a deduction of more than $10,000, even if you paid 20 or 25 or 30. Okay. You were capped at 10, if that makes sense.
Yeah.
Now, with the new tax bill that was just passed, that limit goes to $40,000.
That's significant.
So it's a big change. Now, this will impact people, for the most part, that live in states with an income tax, Kentucky obviously being one of them. And the states with a higher income tax will be more impacted than states with a lower income tax. But also your property tax, your local taxes paid, those all filter into this same bucket. So from a practicality standpoint, I would encourage all of our listeners out there, make sure you keep track of those things throughout the year. Make sure that you keep track of that when you compile all your tax documents, when you go and file your taxes, because it's very possible that you've been someone who has used the standard deduction the last 7 or 8 years. And because of this change, you'll now claim itemized deductions, which will save you money on your federal tax return. This doesn't save anybody money on their actual state and local taxes paid. It becomes a deduction that saves you money on your federal taxes paid.
All right.
Deduction still sounds good, though.
Deduction sounds good. The other big thing, Bridget, that's brand new is that for folks who use the standard deduction, they will still receive an extra $2,000 deduction for a married couple or $1,000 for single for charitable contributions made. So whether or not they claim itemized deductions, the charitable contributions will still make an impact on their federal return. And that's a brand new thing. That's not been the case before because the charitable deductions have always fallen in that itemized bucket. And so really what Congress is trying to do is to encourage people to make charitable contributions. There's an incentive for everybody to do it outside of the godly reasons to do so. There's also a tax incentive to do it now as well.
All right. Thanks for clearing up the SALT today. You can learn more at ChristianFamilyRadio.com or when you visit LockshieldPartners.com.